Hello friends, now in this study session, I'm going to discuss about real options from capital investment and capital allocation learning module of our corporate issuer topic. So here I'm going to discuss what do we mean by real options, what are the different types of real options we have, how these real options are different from financial options, and then I'm going to take few numerical illustrations and same type of questions we may get in our exam also. So let's start with the definition of real options. So what are these options? Of course, they are similar to financial options. When I say they are similar to financial options means these options are also giving right but not obligation to its holder. The only difference is these options are deriving value from real assets, whereas financial options derives their value from financial asset, generally equity share. So here the option holder will have some option to continue, to expand, to abandon, to delay the project, investment, your investment in plant machinery or factory, or launching a new product, or getting into a new geography. So these type of options are called as real options, where you get choice, option to do or not to do investments in the capital projects. Whereas financial options are based on financial equity shares, financial securities, equity share, to buy equity share at a future point of time or to sell equity share at a future point of time. So almost similar mechanism, but the difference is the base security or the asset from which they are deriving the value. So here let's go for the definition part. What it says, some capital investment decision involve a series of decisions taken in sequence at a different point of time. So it means all decisions we need not to make at T0 at the beginning itself. The analysis part, what we have already covered in NPV and IRR, everything we have to decide at T0. But what if decisions can be delayed or can be sequenced one after another, and the next decision will be taken only with the more information, better informed decisions will be done. So what they say is some capital investment decisions involve a series of decisions taken in sequence at different point of time, and these decisions can alter value of the capital investment. Of course, if the information coming is new information coming is negative, we may abandon the project rather than investing more in the project and increasing the loss. We may say let's stop the loss here by abandoning the project. And if the information is very positive, we may go for expansion, going for additional facility, production facility, or going for overtime working, or going for production of a substitute or complementary product. So some decisions are taken today and other can be postponed and will be taken based on future economic events and information. So more better informed decisions will be there. So these alternative available are called as real options, where you have option to continue or discontinue based, and this decision you are going to take based on new information which you will receive over the course of time. So these grant rights but not obligation to the to take actions in the future. Of course, the options will be exercised only if they are value enhancing. As a rational investor, options will be only exercised if they are value enhancing for the option holder. So what are the different type of options? First type of option is timing option. When I say timing option, it means you can time your investment. Time your investment means either we can delay our investment. Rather than investing complete amount at T0, we may say no, we will invest in part and we will invest some part at T0 and then remaining part after some point of time, and that too at my choice. Means with the more information coming in, then only we will decide whether to go for additional investment or not. Or we may go for sequencing different projects. If we are having 4 projects at a time, we may not invest in all 4 projects. Rather than going for all 4 projects, we may go for sequencing, that at present we are going for only project 1 and 3, and then only after completion or after getting the successful result of these 1 and 3 project, we will go for investment in second and fourth project. So this way we can time our investment. So option to delay investment or sequence over time, and these options will be exercised with more information, that is better informed decisions will be done here. So these options give firm flexibility to take more informed decisions. That's it. Number 2, sizing option. Sizing option include both type of option, increasing the size and decreasing the size. So first is decreasing the size, that is abandonment project. If the future cash flow by continuing the project are less than the cash flow what we are going to get by abandoning the project, or in fact if by running the project we will get a loss and by abandoning the project we will get 0, then it's better to go for 0, but at least to reduce the losses. So abandonment project involves comparison between your present value of cash flow from abandoning and present versus your present value of cash flows from continuing the project, and whichever is higher will be opted. Number 2, second type of sizing option is growth or expansion project. If demand is very high, we may opt for, with this new information coming in, positive information coming in from the market, we may think for investment in second production facility to increase the supplies, to increase our capacity. So this type of option is called as sizing option. What type of question we may get? We may get both theoretical, numerical question. They may give situation and ask us to identify the type or classification of the real option. And second, of course, there are certain numerical calculation also. That means whether to accept the project or not with real option and without real option. These are embedded option. These cannot be detached from the original project. Next classification of real option is flexibility option. Flexibility option is taken only if your first sizing option and investment option is already over. Means we have whatever investment we can do or abandonment or growth option, that is already exercised. Now there is no scope for going for investment in extra production facility. And now what if demand is higher than the supplies? So here we may get some flexibility either in terms of pricing or in terms of production process to increase our net present value of the overall project. First, if demand is higher than supplies and if supplies cannot be increased, then we may go for rising the prices in the market for our product. Of course, this is going to have a negative effect also of price elasticity of demand, which is negatively related with the price. So, but if the overall benefit is more, then we will go for increasing the prices. So, this type of option is called as price setting option. Next is, if we can increase our production by changing some production process, either by increasing the production of a product, by working out with customer that if he is okay with some complementary or substitute product, or if we can increase the working hours of our employees by going for an extra shift or overtime. Of course, this is going to create an extra cost of overtime premium paid to the staff, but if the benefit is more than that extra cost, we may go for that option also. And last one, we may work out with some supplier to go for an if he can supply some alternative material which can be used in the production process to increase the supplies. So where these type of flexibility is available in a capital investment project, these type of options are called as your production flexibility option. Next, last one, fundamental option. Fundamental options are those choices which an entrepreneur needs to make based on the new information and events, generally which are beyond the control of that decision maker. So entire value of investment is depending on factors outside the firm control. Example is drilling or mining projects. So initially, based on the prices of oil, we may decide to drill for a new oil well. But after 200 feet of drilling, if the prices of oil goes down, and now the cost of drilling to extract to go for production of that oil is more than what we can realize by selling oil in the market. It's better to abandon the project, and this price of oil is not in the control of a single producer. So this type of situation are called as fundamental option, and which are based on factors which are beyond the control of the decision maker. So let's go for some numerical calculation, how to deal with these real option in our investment analysis, that is NPV approach. So first of all, whenever you are evaluating a capital investment, evaluate that capital investment without considering the real option, because real option is finally it is going to be exercised only if it is value enhancing. So presence of real option will not decrease the NPV. So evaluate the project as if there is no option available in it. And if the NPV is greater than equals to 0, you should accept the project. Ultimately, option is going to increase the NPV only. What if the NPV is negative without considering the real option? Now we will consider the real option in calculation of NPV, whether it is an abandonment project versus continuing the project, whether it is a delaying the project, whether it is a sequenced project. That second will be only there if we have taken the first project. Then what we are going to consider? We are going to consider two things along with that base NPV, that is your NPV without real option. The cost of that additional option versus the value created by that option. So if the net value is higher, is positive, we will go for the original project. What it says, NPV of the NPV with real option is equals to project NPV with option is equals to NPV without option minus option cost. If we are going to incur any cost because of that exercising that option, overtime premium is that one of the type of cost. Price elasticity of demand will kick in if you are going to increase the price. So this is going to create a negative effect on the demand versus the value of option. And if all these put together, these three things are generating positive NPV, we will go for the project. For calculating the value of option and option cost, we may consider decision tree or option pricing model like binomial distribution method. So let's go for some numerical calculation. And this type of question we may get in our exam. So I have created 4 illustrations. We are going to different type of illustration. Let's solve these 4 illustrations. Expected NPV of a project to be undertaken by Tata Steel in Europe is negative euro 0.6 million. So base NPV without option is equals to negative euro 0.6 million. Tata Steel is evaluating an incremental investment option to modify existing technology used in project. So there is some technology which we are already using this project, and project is generating negative NPV. We are thinking to change this technology, upgrading the project. At a cost of 0.25 million, new technology would give flexibility. So cost of option, this new facility will come at a cost of euro 0.25 millions. And this will generate a flexibility to switch among coal, natural gas and oil as energy source. Steel require energy, so we will be able to use any of these three energy sources. The original project relied only on coal. It means the existing facility is getting energy only from coal. But now with this new installation, this new machinery, changes in the machinery with the 0.25 million cost, we will be able to switch between different sources, and we will be using that source which is available at a cheaper rate. The option to switch to cheaper source of energy when they are available has an incremental estimated net inflow of 1.05. So value of option, this option is going to generate additional inflow of euro 1.05 million. What is the NPV of project including this real option to use alternative energy sources? So value of NPV of project with option is equals to NPV base NPV without option minus cost of option plus value of option, which means negative 0.6 plus negative 0.25. I'll rather write 0.25 value of option is equals to negative 0.6 million, negative 0.25 cost plus 1.05. So this is equals to 0.6 minus 0.6 minus 0.25 plus 1.05, not 1.6, negative minus 0.25 plus 1.05 is going to give us a positive NPV of 0.20 millions. So it means we should be accepting the project, accept the project if this option is available. Illustration 2, consider a project which has following cash flow. So there is an original project where the cash flow at T0 is negative 700, bracket means negative 700 crore rupees. It is for 5 years, which is going to generate positive cash flows. This project entitle us to enter a new project. So this project entitles. So if you are not taking first project, second is also not available. And after 5 years, and it entitles, it's not compulsory. We may accept second project, we may reject second project. So we will accept second project only if it is positive NPV generating project. Initial investment in the new project will be 1200 crore, and this annual cash flow, so where we have a T0 negative 700 crore, which will generate 200, 250, 150, 250, and at T5 we will get 180, but this T5 will be followed by another project at T5 which will require outflow of 1200 crore, and then it will generate an annual cash flow of 400 crore for at the end of each year. So from T6 we are getting 400 crores. Life of this new project is 8 years, so it will continue till T13, and last we are going to get 400 crore. Cost of capital is WACC is equals to your cost of capital is equals to your required rate of return, hurdle rate is equals to 18%. Evaluate the present project in light of embedded option in light of embedded option, whether we should continue with the first project or not. Let's first calculate the NPV of both the projects at their starting points. Case NPVs. NPV original project at T0 will be equals to negative 700 plus 200 over 1.18, 250 over 1.18 square, 150 over 1.18 cube, 250 over 1.18 power 4, and last 180 over 1.18 power 5. So 700 negative, 200, 250, 150, 250 and 180. Discounting rate is 18%. The base NPV of first project in isolation is negative 52.04 CR. Means if there is no embedded option attached to this, we will reject the original project itself. But now let's go for NPV of new project. And this we are calculating at T5, the starting point of the new project. So initially it will have a negative 1200 crore plus 400 divided by 1.18 power 1. We are bringing everything to T5 till last 400 divided by 1.18 power 8. It has a life of 8 years. Let's calculate the NPV in isolation. 1200 negative, 400 positive for 8 periods, 18 is the discounting rate, and we got an NPV of 431.03 CR. So it means in isolation your second project is giving a positive NPV, but we cannot take second project unless and until we take first project. So second project is contingent on accepting the first project. So we have to consider these two projects in as a single project. So overall NPV will be equals to negative 52.04 plus 431.03 over 1.18 power 5, because this is trending at T5, index at T5, divided by is equals to negative 52.04 plus 188.41. This is giving us net NPV of 136.37. So we should accept first project at T1 and accept a second project at a T5 also. So this is the option of growth in the business, where you are getting growth with the help of second project. So it is a sizing of type of classification of option. The first one is your what? First one is production process flexibility option. Next, let's go for illustration 3. Illustration 3 is, what are the four classification? The first classification is the timing option, where you can delay or sequence. You can sequence. The illustration 2 is not sequencing, because sequence is already fixed. So there you are not sequencing. Project themselves are in a sequence, where you can sequence yourself. There are 3 projects. You can choose to A, B and C. You can choose to go for B first, then C and then A, or a different sequence. That will come under the first choice, first type of option. Or you can delay a single project. We may take today, we may take after 2 years, depending on the new information which we will receive over the next 2 years. Sizing abandonment, we are now taking this growth option, which we have already considered in the second, whether to go for that project or not. Flexibility, prices we have not considered, but production flexibility, they are changing from only coal to 3 different energy sources option. So let's go for the next illustration, illustration number 3. ABC Corporation is considering a special purpose machine costing rupees 9,000 with a life of 2 years. Okay, normal, your outflow is 9,000 and having a life of 2 years. After which there is no expected salvage value. So after 2 years, this machine is of 0 salvage value. The possible incremental net cash flow for year 1 is 5,000. So it says at T0, your CF0 is equals to negative 9,000. T1, your CF1 is equals to 5,000. However, for year 2, cash flow are based on demand of the product in the market. If demand is high, the expected cash flow. So there are no 2 situations. So these are branches. This is what the diagram what I am using is called as decision tree. The circles denote an event or a point of time, whereas the arrows denote branches, the number of choices we have. So if demand is high, your cash flows will be equals to how much? 6,000, and the probability is equals to 0.5. And if the demand is low, which is having a probability of course 0.5, the cash flow will be equals to 4,000. The company's required rate of return, that is discounting rate, is 8%. Calculate the mean of average of probability distribution of possible NPV. So let's calculate first A part, that there is no option here. So position, situation A and situation B, high demand and low demand. Probability is 0.5 and 0.5. What will be the NPV? In first case, NPV will be negative 9,000 plus 5,000 over 1.08 plus 6,000 over 1.08 power square. So let's calculate the NPV. 9,000 negative, 5,000, 6,000, 8. The NPV is 773.66. In second case, the NPV will be negative 9,000 plus 5,000 upon 1.08 upon plus 4,000 upon 1.08 square. So in this case, NPV will be negative 941.02. Multiplying this probability with NPV, we get negative 470.51, 386.83. So overall expected NPV of the project is equals to 83 negative 0.68 bracket, that means negative, and you should be rejecting the project. This is the expected or mean NPV based on the probability distribution. Now suppose that possibility of abandonment exists and the abandonment value of the project at the end of year 1 is 4,500 only. When will we abandon? Situation A or situation B? Of course in situation B. Situation A we will continue. Calculate the new mean NPV assuming the company abandon the project if it is worthwhile to do so. If it is worthwhile, we will abandon. So it depends whether we will abandon or not. It depends on the present value of continuing versus the cash flow of abandonment. So part 2, this was part 1. Now we are going for part B. What we are going to do, whether we are going to abandon or not, it depends. What is the expected future cash flow? So expected future cash flow, if demand is high, again situation, if demand is high and demand is low, probability will be same, 0.5 and 0.5. Now in this case, we are getting 6,000 rupees positive inflow. We will get an NPV of 773.66. But in second case, we are getting only 4,000 rupees by continuing the project. We should be abandoning the project at T1 where we are getting higher inflow. So in this case, of course, we are going to abandon the project. 9,000 plus 5,000 plus 4,500 divided by 1.08. So we got the NPV equals to 9,500 divided by 1.08. This is the first year cash flow minus 9,000. We got again, still the loss is lower, 203.70. We will abandon the project. Now let's calculate the expected cash flow. So the expected cash flow is probability multiplied by NPV. So it is divided by 2, 0.5 is the probability, 101.85 negative. 773.66 into 0.5. We got 386.83. So the overall NPV is, expected NPV is equals to 284.98, and we should be accepting the abandonment. Accept the project. If demand is high, continue the project, and if demand is low, abandon the project at T1. So this decision will be taken at T1 after getting the information about the demand in the market at T1. So this type of project where you can abandon, where you can decrease the size of the project is the sizing option. So now here, but here of course in first case also we have already compared, assuming that we have already compared CF2 will be CF2, the present value of CF2 is equals to 6000 divided by 1.08. Present value of CF2 at T1 is equals to 6000 divided by 1.08 is equals to 5555 and 0.56, whereas abandonment cash flow CF1 is equals to 4500. So we are accepting this continuation of the project if the demand is high, and with the continuation of the project we are going to generate an NPV of 773. That calculation we have already done. In second case, we need not to do this because the future cash flow itself is lower than the abandonment cash flow which is coming at T1. So it's better to abandon the project. So for first, of course, we should be doing one more additional step before going for the 773 NPV. That is, we should be comparing the future cash flows present value at T1, index at T1 versus the cash flow of abandonment at T1. So abandonment cash flows is 4500. Future cash flow 6000, present value at T1 is equals to 555. So that is why we are continuing, and this is overall generating the NPV of 773. So with the availability of this abandonment option, we should start this project, and after 1 year, depending on the situation of the market, if the market is having a high demand, we should continue the project. If market is having a lower demand situation, we should abandon the project. Last case. Again, a decision tree at T0, we are starting. The project is generating a cash flow of 700. At T1, the probability is 0.7, and at T1, it may generate a cash flow of 2000. The probability is 0.3. If at T1 it is generating 700, we may continue the project. There will be three different situations. CF2 will be 200, 100 and nil, and the probabilities are given. Let's say the CF0 is equals to negative 1000. So 1000 is your outflow. Whether we should continue the project or not. First case, continue the project with a probability of 0.3, you are going to get 2000 rupees and then the project is over. Second case, you run the project for 2 years. The first case, we are going to get a T1 700, and then subsequently for next year we will get different cash flows. So whether we should continue this project, yes or no. Now there are 2-3 ways. You can use joint probability. You can calculate the expected value of cash flow at CF2, then bringing them backward calculation also. So all type of calculation will give same answer. So let's go for first calculation. Calculate step 1. Expected cash flow at T2 will be equals to, if CF1 is equals to 700. So this is a conditional cash flow, is equals to 200 into 0.4, 100 into 0.35 plus 0 into 0.25. So this is going to generate a cash flow of how much? 80 plus 35. 80 plus 35 is equals to 115. This is CF2. If CF1 is 700, what is the expected cash flow, present value of expected CF2 at T1 will be equals to 115 discounted by 1.10 is equals to 104.55. So now what we have done, we are using reverse working method, where CF2 different cash flow we have calculated the from using these different cash flow we have calculated expected cash flow, and now we have brought these to T1 stage. So now we are left with a small decision tree where CF1 is 700, I think 700 plus 104.55 or 2000. The second branch is 2000 and the probabilities are 0.7 and 0.3. Step 2. Step 3. So present value of cash inflow will be equals to 804.55 divided by multiplied by 0.7 first expected cash flow of CF1 plus 2000 multiplied by 0.3 whole divided by 1.0, how much? 10%, 1.10, one more discounting. Present value of cash inflow will be equals to plus 700 multiplied by 0.7 plus 2000 into 0.3 is 600. We got 1163 is the expected cash flow at T1, including the effect of CF2 also, upon 1.10. The present value of cash inflow is 1057.44, whereas PVCO, present value of cash outflow, is 1000. So your net NPV is equals to 57.44. We should be continuing this project at T0. So hopefully everyone understood different type of real options and different type of working with the decision tree. So with this, we are done with our this learning module, capital investment and capital allocation. Thank you so much. Thank you everyone.